Hi, I'm Michael Russo, a certified financial planner with CCR Wealth Management. With the rising cost of medical expenses today to consumers, many people are looking for ways to reduce those costs or find a more efficient use for funding those expenses. Today's video will give an overview of some key facts and differences between a couple options people have to do just that. Flexible spending accounts, or FSAs, are accounts that are used in conjunction with traditional health insurance plans like HMOs. These accounts are funded with pre-tax dollars and can be funded with up to $2,650 per year per person. The funds inside these accounts can be used for a wide variety of medical expenses such as deductibles, copays, prescription medications, and medical devices. They can't, however, be used to fund health insurance premiums. FSAs typically follow the use it or lose it rule, meaning any funds not used inside an FSA in a given year are forfeited. However, these accounts do have a small provision for a 2.5-month grace period, which allows people to use the funds after the end of the tax year. There's also a rule that allows people to roll over up to $500 worth of unused money inside an FSA. So while these accounts might not necessarily reduce medical expenses, they are a more efficient way of using dollars towards your current medical expenses. Another type of popular account that's become increasingly popular recently with the advent of high deductible health insurance plans is health savings accounts, otherwise known as HSAs. These accounts can only be used with qualified high deductible insurance plans. Those are plans that include a $1,400 deductible for an individual or a $2,800 deductible for a family plan. The contributions to an HSA are very similar to an FSA, where they go in on a pre-tax basis. However, the contributions to an HSA have much higher limits. An HSA for an individual can contribute up to $3,500 and up to $7,000 for a family plan. Just like an FSA, these funds can be used towards qualified expenses like co-payments, long-term care costs, dental and vision expenses, as well as qualified medical devices. Probably the key difference in using an HSA versus an FSA is the fact that the funds inside of an HSA are not required to be spent down year over year. Instead, the funds can be rolled over for future years to fund future medical expenses with pre-tax dollars today. Since the funds inside of an HSA are not required to be spent down each year, many HSA accounts now offer investment options similar to those found in retirement plans like mutual funds. These investments grow tax-deferred, and as long as they're used for qualified medical expenses, the distributions are tax-free. There's no limitations on when you can or cannot take distributions from an HSA. However, if you use the funds for non-qualified medical expenses, you are subject to a 20% penalty. However, if you're over the age of 65, there's no 20% penalty, but you are responsible for any applicable income taxes resulting in the distribution. Since these accounts grow tax-deferred, they're funded with pre-tax dollars and have investment options, many people consider them health insurance IRAs or healthcare IRAs. For most people that are maximizing retirement plans already, this is just another vehicle people can use to fund retirement expenses with pre-tax dollars. So hopefully this overview has been helpful for helping you understand how to use an FSA and HSA effectively with your existing health insurance plans, or to make a more informed decision on which type of plan might make the most sense for you. So knowing your options with how to use an FSA or an HSA should help you to make the most efficient use of your dollars for medical expenses. Thank you for watching, and if you have any future questions, please feel free to reach out to your advisor here at CCR Wealth Management.